Is it Franklin? Is it ICICI Pru? Or now Kotak? Which mutual fund is closest to your heart? And Navneet is here, so you better say SBI.
My heart is big enough to accommodate all mutual funds. So I'm still original holder of Morgan Stanley Mutual Fund, though they keep on changing their name. That's true.
Okay, you know, it's a 1 hour session, and last 15 minutes I'll open it to the floor as well. And there are chits which would be passed around, and we are happy to take some questions. It would be lovely if you can send your question, write it on the chit, and we'll be more than happy to take them. So last 15 minutes is exclusively reserved really for the audience. Okay, I'll just do one round of audio check so that we have to ensure that audio quality on the air is good. Akash, starting with you, why don't you count in billions?
Yeah, one, two, that's fine, you can hear me, I think.
Navneet, NAV numbers?
30,000, 31, 32, 33.
Okay, I share BMW, what else? Bentley?
A, B, C, P, Q, R, X, Y, Z. Pick up the stocks you like.
So that?
Yeah, 1, 2, 3, 4, 5, hello, hello.
That's not a GDP estimate, right?
Oh, you can say that.
Okay, I think 30 seconds and we'll be good to go.
Prabhat is here.
There you go. Okay, I'll tell you what, let's start, and Prabhat is just going to take 30 seconds before we mic up. And you know, 2015, and when I say 2015, FY15 has been really a breakout year for Indian markets. We broke out of the pack clearly. After the political mandate, India has emerged as the market of choice for global investors. And this is one year when Indian markets have decisively really moved into a new bull market orbit. But the question in front of the house today is that for FY16, are we in for a treat, repeat, or are we in for a retreat? And I guess my first question, or my introduction is the first question itself. And Akash, there's no point in talking about what happened in FY15. What is important for us to understand what lies ahead. Hi, Prabhat. What is important is what lies ahead. So if you really have to outline 2 or 3 factors which could influence the script of how Indian markets will move in FY16, what would be that checklist?
I think the biggest driver for the markets over the next 12 months is obviously going to be corporate earnings, I think, because you know the first phase of the bull market, which is pre-expansion, in my view, is more or less done. So multiples will hopefully hold, you know, because interest rates will get cut and inflation will be down. But I don't think this market is going to move from here unless we actually start seeing significant earnings acceleration. It's not going to come in the March quarter. It's going to be a disaster, pretty well understood by most people. I think it's not going to come in the next 2 quarters as well. So it's probably looking from September quarter onwards when I think you'll start actually seeing some significant earnings acceleration. So, I mean, you know, obviously you expect to see interest rate cuts and inflation, all that stuff, but I think the single biggest thing which I think investors want to see now is earnings. And so that's, in my view, the one thing we have to look at. And my view is, of course, that earnings will come. You know, there's too much stuff happening in terms of which India benefits from, commodity price decline and stuff, well-known stuff. So I'd be very surprised if earnings growth doesn't accelerate in the second half of this year. But that is the single one variable I would look at. It's plain and simple. If you think that earnings if you don't expect 20% earnings growth acceleration by the end of this year, then I don't think this market's going very far. That's my personal view. So.
Navneet, what is the bull case scenario and the bear case scenario for FY16?
I completely agree with him that the re-rating is behind us. I mean, that was driven by the bottoming out of macro, the political mandate, the global improvement, all other markets have done well. And going forward, the markets would track the corporate earnings. So we have to see the earnings. I was surprised by the survey where more than 50% people said that it would be more driven, either largest factor is going to be government action, the reforms, but I think it is mostly the corporate earnings. And I think if we see the 18-20% that Akash talked about, maybe we can see a 20, of course markets don't give returns in a linear fashion and exactly in line with the corporate earnings, and also at the end of the year, what's your projection for the next 2 years, that would determine, but I would guess maybe a 15-17% would be a good bull case scenario for the next 1 year.
Prabhat, ultimately it's all about evidence. As of now, it's hope and global liquidity which has taken markets to a new high. Do you think now the script of market movement will be a function of earnings and evidence?
So I think, first of all, I think there have been positives, and it is nothing to do with only the earnings. There has been a massive, improvement in India's macro situation. So there was a time when your current account was blowing up, currency was very volatile. We were, one of the fragile 5 economies in Asia, and I think from there we have turned complete 180 degrees. So part of the market re-rating happened on back of that, and the next part obviously was because of the government change and what you call hope factor. So obviously long term, the multiples are a function of both the cost of capital and the growth that you are exhibiting. I think that a large part of cost of capital change that had to happen has essentially been already baked into the market, because you have seen the for example, last surprise cut market didn't react. So market is pretty much baked in low inflation and better current account, etc. So it has to be growth from here on. But if the growth really picks up, then I won't discount some multiple expansion even from here. Because if you look at the overall market makeup, there is a very expensive market still out there, and there is still compared to history, cheaper market out there. So if you start looking at disaggregate the market between the two extremes, the defensives are 15% more expensive than the history, while the non-defensives are 10% cheaper. So it's a market which is actually not really baking that much growth in. It sort of got disappointed and banks have pulled back. So the differences actually widened in the last 3 months or so. So I think if growth comes, you actually could see, I think, more than 20% return. And I completely agree with Akash, what he said in terms of growth acceleration. It'll be lagged, and the evidence. But I think evidence, once it starts, the belief in the evidence and durability of that evidence probably will be much higher.
Nilesh, the core thesis for FY15 has been a stable political mandate, Indian macros are in place, and demise of oil. But if I look at the market behavior, the leadership still rests with pharmaceuticals, with private banks, and to a large extent IT. If the core belief is that economy will make a comeback, then why global dominated sectors are doing well?
So it's not entirely true that all the global dominated sectors have done well.
Barring private banks.
I mean, techs have underperformed compared to, say, banks. Banks are up 80-90%, techs are up 20-30%. Pharma is up purely as a better defensive to technology and FMCG. If you see some of the construction companies, they have multiplied 2, 3, 4, 5, 6 times. So clearly there are certain parts of economy which have done well. There are certain parts of stock market which have become expensive. I mean, it's very difficult to justify one large auto component company's valuation when for last 4 years their profit have grown by 10% and stock is up 400%. So there are various things which have worked. I mean, clearly people have invested in their comfort zone. So you had holdings in some of the sectors which you talked about, you kept on receiving flows, you kept on buying the same stock irrespective of where the valuation is, and probably that has resulted into some of the things which you talked about. I just want to bring one more point into this discussion. Let's look at what is happening in the unlisted market of India. We have seen some of the technology companies, e-commerce companies, some of the ventures, which are all getting money at valuation which is reasonably high. It's getting
reasonably high, you mean charitable?
I'm on a live show, that's why I'm saying that. But quote unquote reasonably high. The quantum of money which is coming in is also reasonably high, quote unquote. So what's happening in unlisted market? Can that happen in listed market? My guess is that probably in one part of listed market, we have already seen that happening. Some of the FMCG companies, some of the autocom companies, some of the even construction companies are trading at very, very high valuations. And probably rest of the market can actually catch up with what's happening in unlisted market based on the flows, both from the domestic investor as well as global investors, based on lack of supply, which didn't come out in FY15 as much as one would have liked to see at this level of valuation. So lack of supply and more demand can create in our listed market, what actually happened in FY 2015 in unlisted market.
But ultimately it's all about growth, Siddharth, isn't it? So as an economist, what I want to understand from you is that when will general growth come back? If I look at the basic numbers, the IAIP data, or for that matter, the credit offtake, it appears that growth is still very, very anemic. The feel-good factor has changed, but the on-ground economic evidence is very, very different.
Yeah, very true. There are two ways of looking at it. In our initial year in the management school, we used to be taught about that two-factor model, right? Hygiene factors and motivator factors. Now, if you see now using that particular model, you would see all the hygiene factors are very well ticked now. The current account looks very well under control, inflation well under control, fiscal deficit looks good, interest rates can go down further. So it's all, these were all some kind of headwinds sometime in 2013 or till early 2014. They are either neutral or coming back as some kind of a tailwind. What is still bothering us is possibly while we still say that there's a surge in confidence at the moment, possibly that's still true in terms of a bit of consumption sectors where the results can be seen relatively quickly. But when you are talking about the long gestation investment projects, the general stance is, I'll rather join the party 6 months rather too late rather than joining it six weeks rather too early. So people will remain cautious. I think we have to see some kind of slow cyclical upturn for the next few quarters before we really see the investment cycle turning around. Just to sum up in terms of our numbers, we are expecting a growth number of around 7.5%, 7.4, 7.5% in the financial year just concluded. Next year, where can we be? We are going with a number of slightly higher, just about 7.8%, not a lot higher, somewhat more conservative than the government's estimate of 8 to 8.5%, solely because of the fact that the big uptick in investment, which really propels India's growth, will possibly would have to wait still a few more quarters.
So Prabhat, what happens in the interim? Everyone is waiting for growth. The evidence is indicating that slowdown or perhaps the real pickup is not here. Flows are strong and too much money is chasing too good, a few stocks.
So I think that the growth is not here is, well, I personally start seeing signs of growth pick up in about 6 to 8 months time. So let's not sort of say that growth is not going to be there forever. And the markets will probably be a bit forward looking as far as growth is concerned. The important thing is that what is the durability of the growth profile? Now, essentially what we have seen, Nikunj, is that we've seen a complete decimation of investment cycle. I was looking at some data, and the banks sanctioned about 1,35,000 crores of project in FY14. This number in fiscal 5 was 95,000 crores. So you have essentially, if you adjust for nominal sort of inflation, then our investment cycle is back to where it started from in 2005. So we have seen a complete destruction, and which is why our economy has been so painful in the sense that you've seen zero IAIP growth for 3 years roughly, which has never happened in last 20 years, because we had a rapidly sort of declining cycle in many areas of economy. So I think from that base, getting a bit of growth is not that difficult. And the second thing I think is that government finances have been very weak. They will improve next year. There will be some spending which will be extra, and some benefits from consumer in terms of oil prices, some sentiment improvement. So I am not that bearish on growth being forever elusive. I think we're probably closer to it. So I was more bearish last year on growth than I should be this year. So evidence, obviously what evidence points to, market tends to do that. That's why market has beaten down banks and et cetera, compared to FMCG. But I think to commit here that the growth will not pick up is probably sort of looking at the rear view mirror and saying, oh, things will still remain bad for a long time. So I think probably it's time to start looking at spaces which have underperformed and start buying those.
So Akash, assuming that growth will pick up, it's a cycle and ultimately that cycle will pay out. How should one position themselves going forward?
Well, I mean, we have a slightly different approach where we are very stock specific. We don't really play sectors. So, I think what we're trying to do is look at normalized earnings for companies. So if you assume, that everyone says that, the last 3 years India has grown at, forget the new numbers, but let's say somewhere around 5%. GDP, and obviously in many sectors, therefore you have, and obviously it's well documented that corporate profit margins are way below trend, right? I mean, I think it's profit GDP is 4%, the long-term trend is somewhere 6, and the peak is 7 something, right? So I think what we're trying to do is look, if you look at companies, you see that if you assume in the next 12, 18 months, you'll get back to, again, under the old series, because I'm still not comfortable with the new series of back to 7% type of economic growth at least. And then you assume that, companies get back to, a normal margin structure, right? So like, for example, if you look at auto, right? I mean, you look at whatever company you look at, you had 20 years of 15% growth, last 3 years is 0. You'll probably get back to 15% trend lines. You'll have 1 or 2 strong years, but if you're a discounter, assume you get back to 15% growth, assume discounts normalize, you look at operating leverage. So you look at what companies are trading at on normalized earnings. I think that's how we're looking at it. We're not really saying that you should be playing defensive or you should be playing, offensive. I mean, I think that's a very, nothing wrong with that. It's more a sector rotation type of model, which we don't typically do. So our sense is that, good quality companies will come back to strong growth. The problem in the market, unfortunately, is that, this is true globally, is that quality has gone to a very high valuation. So the problem is that, it hurts our style because we tend to try to buy quality at a reasonable price. So the game has changed now to, finding companies which either the market doesn't understand that they're decent quality, or there is some question mark around that, and you're making a judgment saying that, it's actually a decent company, the market doesn't think so. Because buying the obvious quality companies are just very expensive. I mean, it's just very difficult there is no margin of error. If you're buying, just as an example, HDFC Bank, an outstanding bank, but it's priced for everything. I mean, even if they grow at 25% compounded, multiple holes, it'll be fine. But you're making a real bet that, and I'm just using HDFC as an example, that you have to be 100% sure that they will deliver what they're saying, because there's no margin of error. So the problem we are facing, and I think everyone has to face, is we are not comfortable as an investment style going down the quality curve. It's a perfectly legitimate way to invest. Buying, some beaten up infrastructure company, or that's fine. It's not. We're not comfortable with that because we don't have conviction, and we tend to make stupid mistakes. And then one bad piece of news comes, we'll make a dumb decision and sell, and we don't have conviction. So if you're trying to focus on quality, it's a very difficult market because it's not cheap and everything is priced. So I think you've got to look at pockets or companies where the market is not valuing them as quality, but they really are a much better business than the market thinks they are. So they're few and far between, but our model doesn't require us to make more than 5, 6 investments a year. So for us, it's okay. If you're running a very large portfolio and you need to make a lot of investments, then I guess you'll have to look at, sector rotation, or you'll have to look at going further down the quality curve and stuff like that. But our working assumption is that growth will come back. I mean, frankly, you should not be invested in the market today if you don't believe growth is coming back. That's an implicit assumption. I think you'll get the next 6 months, probably the market will have an air pocket because there is some doubt developing among some investors that will growth come, because the earnings have frankly been worse than anyone would have predicted. And March will be really bad. I mean, that's, I think, quite clear for many companies we talk to, that, Jan was worse than December, Feb is worse than Jan, March is worse than Feb. And it's just going down. So I think this will test conviction now, because the March number will be horrendous. Then because of the, the unfortunate rains, I think even June will be bad. The quarter is quite mediocre. So it will test conviction. And if you don't believe growth is coming back, then you're going to make mistakes. So I think the working assumption is growth will come back. Second half of this year, acceleration will be clear. And within that construct, I think you're going to find those companies where are not valued for high quality, but actually are much better businesses than you think.
Amrit, I'll take a leap from Akash's answer, which is that in the short term, nothing will improve. That's the period of air turbulence. So how are you laying your bets so that your portfolios don't suffer in this period of mid-air turbulence? And B, where is your stand on quality versus price?
So we are also a quality focused house. I would disagree with that. Nothing is going to improve in the short run. There's a bit of disconnect between the macro and the micro. I mean, by micro, I mean the corporate profitability. The reasons which are responsible for improvement in the macro that Sanjeev or the other people talked about, in terms of we've got control on the current account, inflation is under control, the fiscal deficit has come down. The same reasons are responsible for the impact, the negative impact that we have seen at the micro level. So government has cut down on expenditure big time in last 1.5 years, particularly the wasteful expenditure, which was boosting consumption, obviously is going to get reflected. If we were running a negative real interest rate, of course, it was impacting current account, it was impacting savings. Now that we have got a positive real rates, we ran a tight monetary policy, we'll see the positive positive effect later. I think that government is going to spend good amount of money in next couple of months. I'm not talking like couple of quarters or years, but I think immediately. So they have built a good cash surplus because they had to ensure a 4.1% fiscal deficit. Similarly, the state governments have been allocated a lot more money, and now I think they have a helping hand from the center. Also, that I think this whole it might sound like a cliche now, cooperative federalism, where states are competing against each other. I think a combination of government, the central government and the state government spending in next couple of months will start showing result on the ground. And I think we'll see that in next couple of months when the money really hits the ground. At least in some of the sectors, railways, roads, mining activity would start after the new allocations. You will see some activity in the defense related orders that have been given. So at least the industrial space, I think little bit of discretionary space will start seeing better days ahead. So I'm in the camp where of course the results in March are going to be really terrible. Completely agree with Akash. May not be in June, but I think beyond that, I think people will get a little surprise.
Coming on this quality argument, what is growing is expensive and what is not growing is cheap. You're a quality fund house, so how are you differentiating men from the boys?
No, of course, I think so there are various definitions of quality. What we have done, so when we had a big macro challenges, of course, you try to be as defensive as possible. But when the macro view underwent a change last year, what we did when moving from defensives to cyclicals, what we did was that stay with companies that have higher operating leverage, avoid companies that have higher financial leverage. Wherever the balance sheets are so broken that the repairing of that is going to be really challenging, avoid them. Also, same thing within the financial sector. Wherever you see more stress in the balance sheet, avoid those banks, buy those financials where probably those stress is not there. And I think that operating leverage has played off very, very well. So whether in the auto space, whether in the industrial space, whether in the financial space, I think companies where the balance sheets were in a better shape, I think that has done well. I don't see that changing dramatically. We are not visualizing a couple of 100 basis point correction in the interest rates from these levels that several balance sheets can undergo a change in a very, very big way. So I think one should still avoid those balance sheets which are quite broken. Of course, as he said rightly, there are various ways of making money. There is no holy grail of investing. Of course, from a price point, lots of stocks will make money, but I think you need to be a little more cautious on that front.
Nilesh, so far we've discussed domestic challenges. Let me throw in one more ingredient in the melting pot, which is the global setup. And unfortunately, the world is still fighting deflation. Most of the large central banks are committed to print money. So ECB is committed to print money, Japan is printing money, and then what will add confusion, of course, is what US Fed will do, 2 quarters down the lane. So how do we deal with this dynamic global environment which is changing?
So, unfortunately, investors don't remember what their grandmother told them. So when we were kids, we had studied the story of Vaghaya, Vaghaya, the tiger has come, tiger has come. But unfortunately, when we grow up, we forget the wisdom given by our grandmother. So if you see the quantitative easing, our market shivered and corrected and crashed when people uttered quantitative easing will be withdrawn. When it actually happened, our market went up. So could the same experience be repeated with Fed exit? Our markets start shivering when we hear that Fed will raise interest rate. IMF chief came to India and said that if US raises interest rates, it will be tough for India. No one in the audience asked her the question that, do you think, ma'am, Portugal and Spain and Germany and Italy are better credit than US because their borrowing rate is lower than US and we are paying 7.5%, 7.75, and you think we will be more susceptible? Shouldn't that Italy and Spain and Portugal and Greece and those be more susceptible? So my guess is that as long as my macro is good, my micro is good, I don't really have to worry too much about what happens in US Fed rate. If US is raising rates, how much they will raise. There was a time, I think in 2005, when 10-year US yield was about 5.5% or 4.5%, sorry, and 10-year Indian yield was somewhere around 6 or 7%. The gap was 1.5%. Today the gap is 5.5% and we are still worried about, oh my God, that 5.5% gap is too small. So somewhere I think eventually market will experience from what happened in quantitative easing. If US is raising rates, there will be Europe and Japan who can give us money. We launched a debt fund in Japan in September, and today it has become $650 million fund. The kind of return which we have delivered to Japanese investors, partly because our high coupon and partly because yen depreciation, is something which they will achieve in Japanese bonds probably over next 20 years. So in India, you have the capability to get in 1 year what you will get 20 years in other markets. We have to go and market that. So as long as our micro and macro are stable, there will be temporary corrections because remember what their grandma taught them, but eventually will come back.
So if you want to make money, just go to your grandma and ask her something.
If not your grandma, my grandma.
Akash, I want to encourage you to talk about global liquidity. You got your ears close to the ground. And well, India is the market of choice, but what about over-ownership patterns? 24% of good quality stocks are owned by foreign institutional investors. According to most GEM allocations and some of the articles you've mentioned that India is a crowded trade. We should not expect too much of flows. And I cannot imagine a scenario when we say, FI nahi aane wala hai. That's a nightmarish scenario.
No, I think it's very clear that India is a consensus overweight. I mean, any survey you look at, done by any investment bank, it's very clear that the flow data indicate that. So I think the simple point I've been saying, and I think is now bearing out to a certain extent, is that the next leg of this market leadership will be driven by the domestic investor, not by the foreigners. The appetite for foreign investors to keep pumping in, whatever, $15–20 billion a year and being the buyer on the margin, being the sole driver of the market, I think those days, at least over the next 2 to 3 years, are not going to be likely, because the reality is that India is obviously very fashionable and hot today, partly for the points Nilesh makes that India, you're getting good returns, both debt and equity. The rest of the emerging market world is in really bad shape. You look at Brazil, you look at China's questionable, look at Brazil, look at Turkey, look at South Africa, look at Russia, there's lots well documented. So there is obviously a situation where a little bit like, the Indian election, the Tina factor, there is no alternative, right? But that is not going to last forever, obviously, right? It's not that the whole world will forever sucking wind and India only will keep doing well. So this is going to, at some stage, people will find, that some of the market things are turning, whether it be Brazil or anything. So at that stage, obviously, so there are 2 parts of it. One is that, that within the emerging market universe, I think the allocation to India right now is very biased, very highly, probably the highest I've seen it for a very long period of time. So I don't think that's going to increase in terms of India's market share within EM is not going to increase. Then you go back to see that will EM get a lot of new flows. There is a case, I think, over the next 3 to 4 years that EM will do better, because EM has done actually very badly the last 5 years. If you look at EM, since the financial crisis, EM has massively underperformed the US and most global markets. So EM maybe will come back. But I still maintain, and I do believe that if this market, if India is going to work, and it's going to deliver the 15–20% return we all expect compounded over the next, hopefully 2 to 3 years, the domestic investor is going to drive this. I don't think you're going to get 15% compounding in the absence of domestic investors. If our expectation is that no, the foreigner will keep buying 20 billion and domestic investor doesn't matter, I think that's fallacy. That the foreign investor is up to his neck in India. There is no alternative, is not going to last forever. And at some stage money will, at best, not keep increasing in India. India's market share will come down, flows to EM may come, so you may not see huge outflows, but you're not going to see the incremental 15–20 billion coming every single year. And remember, we are going to be a market of high supply. I mean, the government has talked 65,000 crores this year, whatever, something like that. Yes. That number is going to accelerate every year. There's no choice, right? And corporate India hasn't raised a dime in the last 4 or 5 years of any significance.
I have reported 5 IPOs in this week itself.
So that's going to start. So that so this is a matter of time. So we are a capital short economy. It makes no sense that we don't issue any equity. We are going to be a high issuance of equity economy longer term, because we need capital, right? So so I don't see how, in the absence of domestic investors, this market can sustain 15–20% compounded. So. So my simple answer is you need the domestic to come back. Do not rely on the foreigner. We've got till here because of FIIs. They may not withdraw dramatically, but they're not going to be the buyer on the margin, and they're not going to save this market if we have another leg down. My only point is that.
Navneet Manot is a very jolly man, but the minute you say domestic investors, look at the smile on this man's face. He knows his numbers. SIPs are getting registered every day. 10 lakh SIPs in last quarter. EPFO is allowed to invest in Indian markets. Navneet Manot looks like in the right business at the right time. Tell me, is the domestic investor coming back? And if yes, How much money are we talking?
So against the $15 billion or so of the foreign flows in the last 10 months or so, we have seen $10 billion being invested by the domestic investors into mutual funds. And I think this is not, a flash in the pan, but I think it's a sustainable trend. We have seen over the last couple of years, the savings getting diverted to more physical assets. Across the country you travel, I think there is tremendous stress in the real estate sector. I think people have made up their mind that I need to switch. It's just that you need a little bit of activity in the real estate. But even otherwise, I think the savings pool that we have, and also a couple of measures that the government has taken in the last couple of months. I think Jan Dhan Yojana may not lead to flow into the equity market, but the overall more financialization of the economy will lead to more savings coming into the financial assets. Also, I think, so I strongly believe that our vulnerability to the global events is likely to be less in the next couple of years than what we have seen in the last 5 years. We've been extremely tightly coupled with the global markets. We dance to the tune of global liquidity, global rates, global risk appetite. And you draw a chart of last 12, 13 years of Nifty with maybe even a German DAX, and you see a very, very close correlation. Next couple of years, we will still remain hugely dependent on the global money, but I think to a large extent, I think that's going to go down, because I think the domestic savings coming into the market is likely to increase substantially. Also, I think the pension fund that you talked about, I think we have huge amount of savings, a country that saves more than 30%, which also I believe is likely to increase with the positive real rates of interest and the measures by the RBI and the government in the next couple of years. And a good part of that is likely to come into the equity market. So I think we will provide that, I think, stability to the market in case we see any vulnerability from the global side.
Last time when domestic investors were back, fund managers, they became stars. So are people taking selfies with you again?
Not necessarily, but I think this is a structural trend for next several years. I think the equity ownership in India is abysmally low. Okay. I think we had much higher equity ownership 25 years back, when we didn't have ET now, when we didn't have the live news, we didn't have so many business papers, business channels, dematerialization, this exchange trading at 1,000 places online, and so many things have happened, and we have lower equity ownership, and we are a younger economy with higher savings. I think it's going to get changed very, very dramatically. So $10 billion in a $2 trillion economy is, I think, just too small an amount. I think it's going to change.
Which is so appalling. Foreigners like India, we've got only not even 1 crore active demat accounts. One of our biggest company, HDFC, is owned by foreigners. So I always go on various forums and appeal to everyone. Well, foreigners are trusting Indian stocks. We should also trust Indian companies. So that's a standard appeal which I have. But I'm going to move away from that appeal and talk about the commodity effect, because 2016 will see a substantial movement. Will see a substantial move, Prabhat, because of the commodity effect. Wealth will get transferred. Wealth will get transferred from a commodity producer to a commodity consumer, and that will be a global phenomenon. How will that change the dynamics?
So I think there are two parts to it. One is at a country level, which obviously India is a commodity importer, and we have already seen that impact in terms of India's macros. Why rupee is so stable is also partly because of the fact that we are now in a current account surplus zone, at least for 1 or 2 months, and it will probably remain like that if the oil prices remain here and the economy gradually improves. So clearly there is a wealth of transfer from one country to the other. The second obviously is within the system. So for example, you can take the case of oil. Oil prices have fallen $50, which is about $50 billion savings in the overall Indian scenario, out of which about $12 billion got taken up by the government in terms of raising of taxes, about 72,000 crores. The rest is between the corporates and individuals. Now, depending on the pricing power of corporates, this will be either passed on to the consumer or will be kept back by the corporates. I mean, obviously, petrol prices are largely passed on to the consumer, but diesel, fuel oil, naphtha, which is consumed by corporates largely, some part will be passed on to the consumer and some part will be kept by the corporates. The fact that you're not seeing a multiple expansion because of commodity price falls aggregate basis will argue that there is more benefit to the consumer that is flowing in at this point in time than it is accruing to corporates. Obviously, this analysis is not fully foolproof, but at this point in time, it looks like because of the slowdown in the economy, the pricing power is comparatively less, which is visible in corporate top lines. As this sort of changes and as growth really picks up and the pricing power of corporate increases, I think the benefits from energy prices, low energy prices will also start to flow through. Obviously, companies like autos have very direct correlation, so they benefit very clearly. But if you start thinking about companies which benefit from commodity price impacts, there'll be 2 or 3 sectors you'll come up with. Autos, you'll say probably FMCG, which is benefiting from these kind of price declines. But the profits, aggregate profit of these sectors is much lower than what commodity producers, like Tata Steel has much larger profit than the entire auto sector in terms of EBITDA, right? So it's like 13,000 crores versus if you start adding up. So I think at the aggregate level, there's a huge benefit, but the transfer of that benefit depends on the economic conditions prevailing and the demand conditions prevailing. I think at this point in time, consumers probably have a better hand. And then the last thing I would say is within the economy, there's a transfer happening from rural India to urban India because the agricultural prices are weak. And the trend which was very much a driver of many stocks, for example, which would depend on rural India, were benefiting, so they're benefiting from larger transfer of income from urban India to rural India. That trend has stopped, maybe has gone down somewhat, which is why you're again starting to see some dichotomy between stocks which are exposed to rural India versus urban India. Hopefully, what we'll see is an environment which remains conducive from India's perspective in terms of global commodity prices. One of the positive factors that plays into that is dollar strength itself, because as dollar appreciates, commodity prices tend to turn weaker because all the other economies which are experiencing currency depreciation are paying much more in dollar terms if the commodity prices don't fall. That's why commodity prices tend to behave with dollars. And going by all indications, dollar does looks like the dollar will remain strong. So from India's perspective, that's a very fortunate situation to be in, because at the time when you need capital to grow, if commodity prices remain weak, then you can actually, if you get a 3-year grace period and you can revive your investment cycle and get going, it's a fantastic thing from
But
perspective.
Siddharth, my only issue with this argument is that it works on paper, that commodity prices or decline in commodity prices is great news. Reserve Bank of India will cut rates, but the challenge is transmission. 2 rate cuts, nothing has come down to the consumer. None of the banks have cut forward and they've cut rates. I don't think auto loans have really come down. So transmission, I guess, is the biggest challenge.
Yeah, that remains a challenge in the near term always. Typically, the pattern is the first rate cut doesn't yield much, second doesn't yield much, maybe after 3 or 4, and maybe with a bit of support on some of the other parameters like liquidity, you typically see a much stronger transmission. But the bigger policy message here at this moment is what really you do with interest rate tinkering. You try to manage demand, which has not really been the weak point of Indian economy more often than not. More often than not, over the last several decades, in case of India, the point had been how well you augment supply over a period of time. The good thing about policy making today is the last few months, or last 1 year at least, I would say, policy making is trying to bring the focus back on augmenting supply. Compare today's policies in terms of coal block allocation, or maybe more FDI in some of the more meaningful sectors, or over a period of time reducing interest. All are talking about boosting supply over a period of time. We often have some kind of a debate always, some kind of trade-off between growth and inflation. It's very true in case of most Western nations where they are close to their full employment level, or supply side cannot really go up a lot. In case of India, that is also possibly not true. If we try to really check a lot of things just by interest rates or mechanisms like that which control demand, possibly you reduce demand a bit, but you end up reducing supply a lot more. So rather than trying to do that and try to manage the economy, a much better approach is to really boost supply, which the current set of policy making is trying to do. And in that kind of a situation, not only you possibly achieve a somewhat higher equilibrium in terms of growth, you leave with a relatively smaller excess demand gap over a period of time and generally achieve both decent growth and relatively manageable inflation. See the experience of say 2000, the decade of early part of the decade of last decade, right? Where you actually had that combination. Obviously, global factors were also supportive, but I think we are gradually heading towards that, and over a period of time, I'd be very hopeful. Just one more point, and we briefly touched upon that a lot of initiatives earlier we had been trying to do at a central level. I think another good focus another good change in focus has been to drive states more. Two ways it can happen. The funding, which is coming to states without many conditions, so they can actually decide which projects to invest in. And the other factor can be, the new government emphasize a lot on ease of doing business. I think it's time to move and push this competition to a state level. Rather than thinking about India's ease of doing business, think in terms of ease of doing business in Tamil Nadu and Rajasthan and Gujarat, and let them compete. And possibly an investor can think like whether I'm investing in Rajasthan or Madhya Pradesh, rather than thinking of I'm investing in India, where ease of doing business the rank is 142.
That's a wonderful point, the ease of doing business, and that is what I think the current administration seems to be focusing on. Nilesh, now the session gone by I think was an extremely productive session, both in terms of decisions which were taken on the floor of the parliament and outside the parliament. So which to your mind is the most powerful bill which has been passed, and how will that bill change the dynamics in the short term?
So the most powerful bill which is not passed yet is the land acquisition bill.
We don't know what happens there, so let's talk about what is in the bag.
Yeah, but you can't build factories on Excel sheet. As a fund manager, we believe that way, but unfortunately that's not the reality. So you need land to build factories, and today, acquisition of land is an issue. You take more time than peer group, you pay more price than peer group. If you look at labor productivity, it's one of the lowest in the world. If you look at interest rates, it's one of the highest in the world. If you look at clearances and approvals, it's probably longer than rest of the world. If you look at power cost, it's one of the highest in per capita GDP basis. So I'm making my entrepreneur run a hurdle race when everyone else is cruising on a highway. And despite that, our entrepreneurs are creating commerce, creating companies, and creating industry. So as Siddharth mentioned, the ease of doing business has to come through. And will it come through new legislation? Probably yes, but will it come through the mindset change? I think that's more critical. About a few years back, we had met a multinational company who wanted to set up an orange juice plant in Nagpur, and Nagpur has one of the best oranges in the world. But the time taken to transport that juice in a refrigerated container from Nagpur to JNPT was much more than what they could afford. In between, the refrigerated trucks were open to check about the quality and what they were being transported, and in the process, the juice was getting kind of stale. So net, you couldn't put up the factory to convert that oranges into juice and create value addition for everyone. Now, that mindset has to change. The excise inspector, the pollution commissioner, the octroi agent, the shipping agent, the port agent, they all have to think that, look, it's my job to push this container ahead so that oranges can be converted into juices. Unless until we change that mindset, I mean, clearly our markets will have their ups and downs.
So what happened to that orange juice container finally?
We are still eating oranges, not the juice.
Prabhat, bad or awful has become bad. It has not become great. The rate of change is productive, but rate of change is not fantastic. When you speak to companies, you interact with, what are the feelers you're getting? What has the new administration done? What can they do? And what can be achieved?
If you speak to companies, I don't think you will hear very positive.
So why are you bullish then? Growth is not there, companies are not saying good things.
Well, if you had gone in 2002 and done the same thing, you would have heard the same answers, exactly the same, you would miss the biggest opportunity of Indian markets. Okay. So the point simply is that investing is not about, what you hear today, is you have to make judgments, as Akash earlier said, that you have to believe in what is going to happen rather than what is happening today. So you have gone through a phase of last, well, as I said, the investment cycle is rather destroyed completely. You are still a shortage economy, so you can invest a lot actually and create productive assets. The issue essentially is that whether the right conditions are being put in place for a growth recovery. So growth recovery, so now we have money because we have current account surplus, we have all the conditions to cut interest rates eventually, and that will happen. And at the same time, so we have capital and we have opportunity, and the government is doing all the right things to create those opportunities. For example, mining If that happens, if the mining takes off in coal, eventually you will have power investments. So I can definitely see that there will be a pickup from the levels you are at, and there will be a steady pickup. It will probably be, if you get the right conditions in place, it will continue to sort of go up like it went up in 2002. It was not one day that the market earnings just started going up suddenly. It took 7-8 years to reach that peak. But the peak journey up to that peak was very profitable for investors. So I think that is what you're looking at. That's what you're playing for. Otherwise, obviously, there's no story here.
Okay, I've got some questions in my hand, but I would encourage you to participate more. It's a rarity to really have an interaction with such a panel, so I would encourage many more questions. I'll just do one quick round of Q&A, and then I'll open the floor to questions, and I'll take some chit cards. Prabhat, what's your big idea for FY16? What's your big sector? Where are you laying your bets in terms of the theme?
It was last year it was financial. I think it sort of remains financials for us, primarily because I think a macro recovery will first be manifested in this sector. I don't personally believe that loan growth will pick up very sharply in the next sort of 1 year, but market will make a bet about that as the market sort of sees the headline growth recovering, investment cycle recovering. So it'll still be financials. India is a much underpenetrated country in terms of leverage and overall. There are pockets obviously of over leverage, but I think as the investment cycle starts to grow, the visibility on the long-term growth of this sector will be very large, and I think you can get compounded sort of growth for a very long time in the sector. So it still remains to be the financial sector is still something that, like its size, it has large companies, it can and I think it has corrected actually. So that's another positive. Though, and the correction is marginal compared to where it has come from, but it's still a correction compared to a lot of other stocks which have just gone one way up, in the name of being safe havens. So when the recovery happens, people rotate away from the sectors most likely.
Akash, financials has been your big bet as well, but how does one play into financials? You've never liked PSU banks in the past, and congratulations, that call has worked like a charm. So what's your big idea, and how are you betting in financials this year?
We would continue to avoid PSU banks. Nothing against PSU banks, but I just think they're in a structurally difficult place with the government's inability to give them capital and the constraints they have imposed on them by the government in various forms, from compensation to, everyone is well aware of all those things. So I think you can, we have a couple of NBFCs. I would not like to get into names here because of regulatory reasons, but I think there are a couple of NBFCs which are, which are well capitalized, which can grow strongly. You can play that. There are a couple of older private sector banks which are again have got size and scale, which are trading slightly above what the PSU bank valuation is, but clearly the management is better incentivized. There's less government interference, etc. So I think there are, as Prabhat says, the financial sector is a very broad sector. You don't necessarily need to play PSUs. The PSUs, I would make the one caveat that if you genuinely believe, and we're still thinking about this, but if you genuinely believe that the government will allow these banks to function in a more commercial manner, it's a great trade. It will probably give you the single biggest upside from here will be, State Bank or I would stick to the top 3 or 4 PSU. But the government itself has said they're only going to finance 6 PSU banks, whatever. Yes. So, why go below that anyway? It makes no sense. So look at the top 4. The government itself is telling you that. So so I think the call there really, I think it's still too early for us to make that judgment that this will actually happen, because there's tremendous vested interest, pulls and pressures, etc. But there is some stage, I think, going to be a huge trade, massive upside in the PSUs, at the top 4 at least, SBI, PNB, BOB and whatever. I think the government frankly has no choice, because they can fudge here, fudge there, delay something, postpone Basel III, allow tier 3 subordinate, do these various fudges, but this will not continue beyond a point, because if you want the economy to grow at 7-8%, 70% of your banking system can't be in a position that it can't lend more than 7-8%, 10%, which is what it is today. So the government someday has got to face the music, and how they do it, I'm not sure. But so I think I would advise people, and people have obviously different views on this. But if you genuinely believe that you're seeing change, you should look at that trade. It's too early for us, because we're not yet convinced that the government has enough of its back to a wall to genuinely make the changes required. But it will happen. And I would urge everyone to look out for that, and that will be a really huge trade sometime in the next 12, 18 months.
Navneet, where are you shopping?
Same. So I believe in the reversal in the investment cycle. So I think the industrials, even from, I think there's a lot of potential in the exports as well in that sector. So I think the overall industrial manufacturing. So I think in next couple of months, as I expect the government spending to go up substantially, followed by a private capex, but at a later stage. I think within that, so if you are into forging, abrasives, compressors, bearings, gears, everything. So I think the whole industrial space to me looks quite interesting. Even in the consumption, I think we have a very long way to go. Of course, I think there is a part of the consumer sector which is quite richly valued, maybe the staples, but I think in terms of discretionary spending, urban consumption, also the premiumization within some of the segments, I think that it's got a lot of lag. Within the financials, I think there are three very powerful forces in the finance globally. So you have disintermediation, which is a very powerful force where borrowers go directly to the market, and maybe even the lenders will go to asset managers and wealth managers. You have digitization, I think, which can change the landscape of financial services very dramatically, and a much more stricter regulation for the traditional players in terms of higher capital and higher compliance cost. But there would be a new players who will probably bypass that. So it's going to be a very interesting space, because India probably is going to be far more bigger in terms of financial services where we are today, but the winners and losers could be quite different than the people who are there today. On the PSU banks though, I think last couple of years we have stayed with private sector banks and well capitalized, well run, high growing NBFCs. That trade has done very well. But I think I get an initial signs that I think governance reforms are happening. It looks like the government is quite serious about the governance reforms.
You're saying this because you represent SBI.
Maybe because of the, I know because I'm from SBI, maybe. I think more, whatever you read, whatever you hear from the government, I think they're quite serious about the governance reforms. I think they have the franchise. I think some of them, I think particularly, again, I'll repeat on those three forces. I think those who are making good investments in the digital finance, I think the future is that. I think those could be a big beneficiary. But again, I think you need to probably wait and watch and then you can take a pick. So these are kind of early days. But there are like a couple of other space. Agronomy is the other one. I think in agri-chemicals or chemicals, I think we have similar advantage as a nation that we had in pharmaceuticals. That space over the next several years could be quite big, both from the domestic demand as well as what we can do in the international arena as well. And there are several interesting companies.
I'll use my privilege to ask last question, and then I've got a big deck of questions we'll take. Nilesh, we've been talking about what to buy, but investing is not always about what to buy, it is also about what not to buy. So for FY16, where would you not invest apart from metals? Metals, we know the answer. The cycle is not on our side, and that's the easy one out. But give me something new, a new thought.
So any company which is very heavily leveraged, which has very, very high debt, probably it's worth avoiding. Any company whose earnings growth is likely to be far lower than its PE ratio, that's probably worth avoiding. Any company where the governance standards are very, very poor, and I'm using very, very poor, not just poor, they are worth avoiding. So if you can avoid debt, high debt, if you can avoid very poor governance, and if you can avoid expensive valuation, you should be home.
My grandmother never told me this, but this my professor also told me in B school. Avoid bad companies which have a high debt and which don't have a good quality of business. I learned this 20 years ago in my MBA school. I want to know what your grandmother is telling you now for FY16.
So my grandmother is telling me a few things. One, she's telling me that I should go and meet Mr. Warren Buffett. And I should, go and meet investors of Mr. Warren Buffett also. And tell them that, look, I am a small fund manager from India, and for last 18 years, my company has managed a fund which in US dollar terms have delivered 4 times more return than what Mr. Warren Buffett has delivered. So we are outperforming the God himself.
SEBI law says past performance is no guarantee of future. That's the first thing you read in a mutual fund document.
Yes, but my grandmother says that history always repeats itself.
Okay, I'll open it to floor, and it's a lovely coincidence. Nilesh, I have the first question for you. Which what should be the broader asset allocation for next 2 to 3 years between equity, fixed income, bonds and primary markets?
If you have the risk appetite, 100% in equity.
100 means 100, like 100, 100% in equity.
100,
Okay.
and I would have put another 0 provided market was in 2013 valuation.
Okay.
But since it is not, you have missed that bus. If you have the risk appetite, you will have to take 15, 20, 30% downside. But clearly, we are at a multi-year bull run. Stars are favoring us. Your interest rates are coming down. Your commodity prices are down. The government seems to be moving in right direction. You could be arguing with the speed, but not with the direction. The earnings growth are expected to come back. Our market is not as expensive or as much premium to global markets as it used to be. So put all these things together, we are probably at a similar phase like 2004 or 2005, where you looked back 2002, 2003 delivered great return, but even in 2006 and 2007 great return was made. So take the risk, you won't
100%. That's what Nilesh seems to be endorsing. Okay, it's a very interesting question, and Prabhat, I would encourage you to answer this one. Is there a bubble or a big bubble in the entire e-commerce space? If stocks like Alibaba have created a market capitalization of more than $200 billion, can there be a serious reversal in the e-commerce space, and can that lead to a global chaos?
Well, I think there is, so I think the markets and markets. The US is a market which is probably well discovered comparatively, and there are a lot of e-commerce companies there. The Chinese, obviously, market is what you're talking about. There has already been a correction, by the way, in internet stocks globally, and I think some of the froth has gone out. In India space, we don't know because it's the private money which is funding them. So in the marketplace, we really haven't seen much. There'll always be a bubble in a space which is expensive globally, and where you really are not sure what success means. So this is like a venture capitalism, which will, when the stocks get listed, will come to the equity markets in India as well. And now that SEBI is talking of relaxing the norms for startups, you could well see some of these companies get listed in India. So far, we didn't really have a choice of seeing these companies because of the fact that profitability criteria applied. So I would guess that on a broad basis, there will be a bubble once these companies get listed in India. There will be many, so if they get listed in early stages, which could happen because 2 or 3 listings and the rest of the market will follow. And there will be very few winners, especially in this space, which is where you have traditionally that 3 or 4 companies tend to succeed in a particular either horizontal space or vertical space. So my guess is that the chances of people going wrong once the listings happen will be very high, and simply because the models are not yet frozen. But is there a long-term opportunity? Yes, of course there is. There's a fantastic opportunity, especially in a country like India. What do you think e-commerce space will look like in total market cap? Now, it might be concentrated in 3, 4 companies or 5 companies or 10 companies, but when your listing happen, there will be 100. So you have to be prudent enough or lucky enough, let's say, to have picked the right 5, 6 months, and that, even though they'll be expensive initially, will still make money, I would think.
Okay, the next card says Akash Prakash. And Akash, in the last decade, most of the retail investors have put money into real estate. Now the situation is there is no exit in real estate. Do you see a black swan-like event happening in the economy, and could that lead to wealth destruction?
Well, by definition, a black swan is something that's unexpected and so I don't think this is something which is not totally out of the blue, unexpected. So number one, but yeah, but just to, I have friends of mine who do private equity, real estate, all for a living. They've never seen conditions this bad for last 10, 15 years at least. So I think there is going to be pain in real estate for sure. I'm not sure of the extent of leverage at the retail level, because obviously for this to create a discontinuity, you need leverage at a retail level and over leverage, people buying 3, 4 apartments and hoping that they would sell one, make the money and use that to pay the second one. So I'm not sure how much of that, I don't have a good enough feel of understanding how much of that has happened in India. But at the developer level, there's clearly huge leverage, and especially if you start looking at the so-called there's a lot of disguised leverage at developer level, right? Structured deals, structured transactions, stuff like that. So I think real estate is going to be a very tough asset class. It is globally illiquid and a tough asset to get rid of. So I think you're going to see pain there. I don't think it's going to bring the economy down or bring down the banks or anything of that type. I don't think you have that type of leverage lending by the banking system that it will take the banking or asset quality of the banks down. But pain for sure.
Okay. Final question, and Siddharth, this one's for you. And it says, what about global challenges like Greece? What about Europe? Can they spoil the party? Can they spoil the mood? Can central banks continue to print their way out of prosperity by printing money?
Well, two things. That's definitely some kind of a risk, but when your house is in order, your level of resilience is a lot more. 2013, amongst so many other countries, we took the most of the hit because our current account deficit used to be $80–90 billion. You used to fear every day and that how would you fund that? Today, on the other hand, this financial year, we are actually predicting a tiny current account surplus. So the fact of the matter is that by the end of this year, the Reserve Bank will possibly add another $50–60 billion to its reserve kitty. So the level of resilience is far superior on one hand. That's the defensive argument. And the more aggressive argument would be, if you don't run away completely from the EM space, which other EM will you pick up? You have to pick up one.
My apologies, we've really gone past that 60-minute window, so I will not be able to accommodate all the questions. But if I have to summarize our today's interaction, I guess the message from this panel is loud and clear. Take that leap of faith. Believe in India. In the short term, there could be mid-air turbulence, 5% correction, 7% correction, but India is in a sweet spot, only large economy, which is where earnings are likely to grow, inflation is down, and demographics are on our side. Let's put our hands together for this lovely panel, and it's really been very engaging interacting with all of them. And I think Kishore is ready, so I would like to hand it back to him.
Thank you, Nikunj, and all the panelists for a very, very insightful, exciting, and engrossing discussion. I'm sure each one of us has ended up being richer in terms of knowledge, understanding, with cautious optimism and a mix of both optimistic market condition, taking a leap of faith, along with the fact of tracking the important data points to monitor to remain cautious and over the top in your investment. So I'll just ask the panelists to wait for a few more minutes, and I'll take this opportunity to acknowledge and facilitate the winners of our last year's annual forecast contest. So I'll just list out the names of all the winners along with the asset class, and I'll request each of one to come up on the stage, please, and I'll request one of the panelists to please hand over the gift to the winners. Anil, if you can just bring the gift to hand over to the panels. Okay, so for Sensex, the winner was Umang Khetan, who predicted 27,700, and the Sensex closed at 27,958, so very, very close. So I believe he is not present in the hall today. For crude oil, I think the winner, Mr. Deepak Seth, was more a winner because of luck rather than anything else. He predicted $73. So obviously way off mark, but the most pessimist of all the predictions, I believe. Now the other winners were very accurate predictors. So Kunal Shah for USD INR predicted 62.5, and the USD INR closed at 62.59. So again very close. I think he is also absent today. For gold, 1190 was the prediction by two of our participants, Kaushik Pararis and Jagdish Bhanushlal. I believe they are in the hall. If they are, please come onto the stage, please. Incidentally, gold had closed at 1187.29, so very, very accurate prediction to that extent. We had a very, very close fight in GSEC predictions with a lot of at least 5 to 6 winners. So the prediction for GSEC was 7.75, and it ended up with 7.74, so it would have been very difficult to be more accurate than that. So I'll just list out the names. So Sanjay Bombalkar, Mr. Ajay Bagga, Shaji Nair, Neera Morakia, Gaurav Parekh, and Parthiv Dalal.
I don't know idea. Guys, congratulations. Thank you. Thank you.
Yeah, sure. Sir, sorry.
I should get out of the way. How are you? Nice seeing you. Huh?
Good prediction.
Oh, is it?
I'd like to now call upon Amit Khurana to give a vote of thanks. Amit has again been a very, very active volunteer in IAIP for the last many years. This is not April Fool prank, Amit. Please come on stage.
Well, I guess we should be renaming the April Fool's Day as the April Wisdom Day, so to say. I'm sure you all enjoyed the discussion and took away some defining thoughts on some of the asset classes and sectors to look out for allocations over the next 12 months. On behalf of the IIP, it's my pleasure to place on record a thank you to all our panelists, our guest speakers. I would request you to give them a great applause for this great value addition that they have done for us. Thanks to our moderator, Nikunj, for asking some very interesting questions and getting the right perspectives out. I would also, a big thank you to our partners for their support, the BSE, ET Now, and the support from Mint. Thank you to you all, the audience. Your presence is a big booster to us at the IIP board, the staff and the volunteers. And last but not the least, our volunteer team, the staff at the IIP office and the CFA Institute for all their continued support. We all look forward to your presence next forecast event as well. Have a great long weekend. We'll see you all next forecast event. Thank you very much.